everybody. I am here with my friend Jim. He is a lender that I work with periodically. And we got on a phone call the other day and I started asking him questions about some mortgage programs. And after some discussion, he and I thought, why don't we educate everyone about what we're talking about? So I get a lot of questions about different programs, how do I get, I get a lot of questions about mortgages. So what we're going to talk about, I'll introduce Jim, I'll tell you what we're going to talk about, but first things first, if you like this video, please hit hit follow so you can see what we do next. I'm going to put out a series of videos on different educational things. You can ask questions in the comments. Jim or I will get back to the questions and answer your questions. So make sure and put your questions in the comments. The main thing that I was talking to Jim about was Governor Lamont's new program. It's called Time to Own, and it's a Connecticut program. So I was asking Jim about that. He has some information that he'll share with us on that. I've got some questions that my clients typically ask me about mortgages, so I'm going to ask Jim some of those questions. He can clear those up. And then Jim's going to talk about some, questions that he gets on mortgages and some good advice and some good ideas from a lender, straight from the source, so you can learn a lot from that. So I'm going to let Jim introduce himself. Jim, hello, welcome.
Hello. Nice to spend some time with you. Wendy, as you know, I've been doing mortgages for 25 years. Which is a huge company.
Yep.
We don't do a lot of national advertising, so we're not as well known, but certainly Realtor. We primarily focus on purchase transactions. As much as we do refi business, our main focus is purchase transactions.
And I know Jim is really great at educating his clients about the whole process, start to finish. So, like I said, the first thing that maybe you can help us understand is, and I've gotten a few phone calls from clients asking me about the new program that Governor Lamont just instituted. And maybe you can give us an overview of what it is, the Time to Own program, what it is and what it's intended to do.
Sure, absolutely. Well, the program itself, and if anyone wants some additional information, just email one of us. We can send you a one-page flyer that summarizes the program itself. It's really somewhat of a grant program. In Connecticut, allows for anywhere between $25,000 to $50,000 that could be utilized towards a down payment or towards closing costs. And that's hugely helpful for a lot of individuals. Once again, you have to qualify for the program, so it's not for everyone. But it's a tremendous program for individuals in certain targeted areas, certain target economic areas that the state is trying to develop even further. So there's a lot of different ways in which you can qualify, but it essentially is what's called a silent second, meaning there's 0% interest. You're not charged interest on this $25,000 to $50,000. And what's nice about this program too is that even though they call it a second mortgage, it's a forgivable second mortgage.
Right.
And what happens is every year for 10 years, 1/10 of the balance is forgiven. So in theory, if you stay in your house for 10 years, that second mortgage is going to be 100% forgiven. And that program itself is really to deal with the fact that a lot of people in the inflation that we've had in this country and a lot of people struggling. And to help meet those needs, individuals can qualify for this grant, which will help them get into a house.
And is this, so you talk about it being a silent second mortgage. Is this something that they'll make payments on during the life of that silent second mortgage?
They actually don't make payments on it. It's set aside so that, and that's why it's 0% financing. So in many ways, it's almost like you're getting a grant for 1/10 of it every year.
Right.
A lot of people won't even realize that they have it.
It's a great program that some people will qualify for, some will not. The only way to know is to really apply and see and check out your options. So, like I said, a lot of people asking about it. Good information kind of clears it up for me and for my clients and who are very interested in struggling with that down payment. So I think it's a great program. But again, you don't know if you qualify unless you talk to somebody like Jim and find out. And there's a number of other programs that we'll talk about a little bit later on. So that's why getting in and talking to your lender early on is key as well. So I end up getting clients when they're ready to purchase. Oftentimes, not always, because I have a newsletter that I send out to people who aren't even looking at houses. Where I advise people about getting their lending in order early on. What do you suggest? How early do you suggest somebody does that?
It's really a great question, Wendy. I would say anytime if a client is looking to purchase a house, sometime over the next year or two, that's when they want to talk to a loan officer and start getting the information that they need. That way that if they have any unique situation or there's some opportunity for improvement, they can make sure that they're qualified by the time they're looking to purchase.
Yeah.
And a lot of clients don't realize this, but the way interest rates now work, it's what they call risk-based pricing, which means the better your credit score, the better your interest rates. So your loan officer should not only talk to you about what your current credit scores are and relative to rates and that type of information, which is hugely important, but also what are the things that I need to do to even better my scores. And if I have a 680 credit score as an example, maybe I need close to 6 months to a year before I'm going to have something in the high 700s.
To lower that interest rate,
Exactly right.
The earlier you get involved, the more opportunity you have to lower that interest rate.
It is so true. Self-employed borrowers don't necessarily understand how it works from a qualification perspective. New home buyer programs, some of them have specific requirements that you have to meet by the time you're looking to purchase a house. So really, not only for the education piece of it, but if there are things that can be done sometime between now and purchase, it might take a year or two. I have plenty of clients that followed my advice when it comes to a roadmap and were in excellent position by the time that they bought. I have other clients that looked at it and said, I'm interested in buying a year or two from now. They have the pre-approval, everything looks great, and all of a sudden they find a house that they fall in love with.
Yeah.
And that can happen as well. You don't want to be in a situation where you find the house of your dreams and then you have to get a pre-approval.
Right.
And it puts you way behind in terms of the overall education process, improving your credit scores, maximize the products that are available to you, identify what type of savings that you ultimately need. And when you look at buying a house, it's very similar to any type of financial planning that you do. It's not something that is done typically within 30 days. I know a lot of clients end up saying, all right, well, my lease is up in 90 days. I'm going to start looking right now.
Yeah.
And that's fine. We have plenty of clients.
It can work. I've made it work, but do you want to be in that position? We don't, ultimately we don't want to be in that position. We can do it, but best case scenario, you take your time, you're prepared as you're moving into the negotiation phase, into searching for the house you want, and maybe you see that house you love, and then you get to, and you have to have it, and we rush into it, and, we find out there's something wrong at, once we get to inspection, and, we've rushed into this process. So you want to be prepared. Yeah. So I have a list of notes because I have so many things that people ask me about mortgages and being prepared that I don't want to forget anything. But closing costs is another thing. That's a big thing that people ask me about often, and I always refer them to their lender. But what sorts of things? Is there a rule of thumb? That you can use, and it's never going to be completely exact. But as far as price of house, type of loan, closing costs, percentage or amount. Is there some rule of thumb you could give us, or am I just crazy?
Well, you're certainly not crazy. So in terms of a rule of thumb, obviously the best way to do it is contact a loan officer.
Yeah.
But if you're trying to start to get a feel for it, and again, it does vary depending on what town you're in.
Yeah.
The one way to look at it is approximately, let's just say a $300,000 purchase price, approximately $6,000, and then add to that 8 months worth of taxes. So your taxes are $500 a month, 8 months at $500, you're looking at $4,000, plus the $6,000, you're looking at about $10,000 for a $300,000 purchase.
For your closing costs.
In total closing costs and prepaid taxes
Yeah.
and insurance. The reality is certain towns have less than 8 months, but as a general rule of thumb, that's about what you're looking at. And so there's not a benefit. Sometimes clients feel like, well, I'm going to wait until taxes are due July 1st for 6 months. I'm going to wait until July to buy my house because the sellers have already paid that. There is no benefit.
No.
So if the seller has already prepaid 6 months worth of taxes, then at closing, you have to actually pay that now.
Yeah, things are amortized. Yeah.
Yeah, exactly.
I mean, yeah.
So it's going to work out to be about 8 months, no matter when you buy. And that's why I use it as more of a rule of thumb rather than just telling people a percentage of the purchase price. There are certain towns that have much higher monthly real estate taxes versus other towns. So it's too hard to do it that way.
Yeah.
For a $300,000 home, you're looking at, in the case that I brought up, 8 months worth of taxes plus about $6,000. Now, if you're more towards $200,000, you're going to be somewhere around $8,000 or $9,000. If you're going to be, much higher, $400,000, $500,000, well, then you're looking at $12,000, $13,000. It really just depends on the taxes are.
Yeah. And like you said, you can always contact, a loan professional and find out for sure, and the process. So that brings me to the process of getting pre-approved. I always request that, or suggest that anyone who comes to me and they're interested in getting, starting to look at a house, it really makes no sense to start looking at, in my opinion, to start looking at houses if you're not pre-approved. Because if you find the house you love, we can't make a move on it. We can't do anything until you're pre-approved, because nobody's going to accept an offer, and a lot of people may not know this. People won't accept an offer unless homeowners won't accept it unless there is a pre-approval attached to your offer. They want to know that you're pre-approved already to purchase and for your loan. So get pre-approved. So what's that process like, Jim?
Great question. Depends on whether or not you're doing it the right way.
Yeah.
And with 25 years of experience, I can tell you there's a right way and a wrong way.
Mm-hmm.
You can go out on the internet and get a pre-approval.
I've experienced the wrong way with some clients, so unfortunately for them, yeah.
Yeah, I understand. So you certainly can go out on the internet and you can get a pre-approval letter. The thing that people don't necessarily realize is that, let's say you go to what you think is a safe way of doing it. You go to a bank and you get a pre-approval letter from a bank. That sounds great in and of itself. What a lot of people don't realize is that a bank loan officer is not licensed. They have a registration number, but they're not a licensed professional. Because they're not licensed, listing agents know this. They know that if somebody in the public wanted to be a loan officer the next day, they could do so if they went to a bank.
Right.
They don't have to pass a government test. They don't have to pass state test. They don't have to do the same type of continuing education requirements a mortgage banker like myself. There are, so a listing agent, they get one from the internet, they get one from some bank, or they get one from a mortgage banker. They're going to value the mortgage banker's pre-approval letter itself more than those other entities. The reality is when you go into a bank loan officer doesn't have to really earn the business. You walk into a bank, you ask the manager, the loan officer, they put someone in the corner. They go out, they fill out the application. The reality is the better loan officers don't work for banks, in part because of this. Because listing agents know bank loan officers generally are not great loan officers. There are certainly some exceptions to that rule. But that's how it was done in the olden days. You'd go to a bank and you'd get your pre-approval.
Yeah.
Now, they meet with someone like myself. Typically, it's online or it can be in person. Just with COVID and everything, a lot of people are and in that regard, what happens is the customer will fill out an application based off of that information, and they're looking at their criteria. I'll issue them a pre-approval letter that is subject to income and asset documentation. And I say that because that's the right way to do it. Get the income and the asset documentation because, as I indicated before, the mortgage guidelines, each product is about. So there are a lot of things that customers will do that are just, it's nothing nefarious or anything like that. They're doing things as consumers,
Right.
not thinking it's a problem. They might have $3,000 in cash at home, and they deposit that $3,000. And depending on their income levels, we tell them, according to the federal government's mortgage guidelines, we can either use that money or we can't. So in some cases, customers will do themselves a disservice by, once again, not talking to a loan officer early on in the process so that we can advise them what to do with those funds.
Understanding that, yeah, and how that
Exactly.
affects their, yeah.
And then the other thing that is hugely important as well is that if you're a quality listing agent, you typically are reaching back out to the loan officer. When you have offers, let's say it's one or 2 or 3 different offers, you're not necessarily saying to your seller, just take the highest offer. Because you want to recognize the individual that you're working with, you want to make sure it's a valid pre-approval. You don't want to get 7 days before closing and find out the customer doesn't qualify. So
Yeah.
I get calls all the time from listing agents saying, did you pull credit? Did you look at their income? Did you look at their assets? Depending on those answers, that either strengthens or weakens your offer. So cutting corners like that is no way to go. And unfortunately, a lot of loan officers don't do that extra step because it is going to work on our part. And customers that have pre-approval get frustrated because they never get their offers. And they
Right.
never understand why.
Right,
a lot
and
of
we
times-
do that.
Yeah.
We call the loan officer, when we have a list, when we're the listing agent. We'll call and check up and make sure that due diligence has been done, or that that you, what is the debt to income ratio? Have you, like you just said, we do that for sure. I had an example of one where we had our pre-approval letter. It was more of an internet company, and the client came to me with it, and they hadn't done the underwriting ahead of time. They just issued a pre-approval letter, and once we got our offer accepted, then they did the underwriting and said to my client, "We need $40,000 more for your down payment." It was an FHA. It was an FHA. We lost the deal. We literally lost the deal. So, those are all things to keep in mind. It was the home of her dreams. And so it was really unfortunate. So it really does make a difference. I work with a few lenders, Jim and a couple others that are of this caliber, and you really got to pay attention to who you're working with and how, so you don't lose those deals. It was heartbreaking for this poor family. So you don't want those situations to happen. So I'm just making sure I've gotten through all my questions, pre-qualifications, closing costs, and interest rate, locking in interest rates. Now, interest rates are, they're heading up, but, I've been saying this to a few people. Historically, we're kind of, it's the new normal. We're kind of at normal rates now if you're looking long-term historically. I bought my home that I'm living in at, I want to say 8%. If you look at the 30-year interest rate, it goes, the graph goes like this, and we're down here. So yes, they're higher than they were over the last 2 years, but that was in response to COVID and what the country was going through. So we've been spoiled with, and rightfully so. We needed that with these low interest rates. But where are we right now, and where do you see it going?
Well, the average rate over time is 7 to 8%.
Yeah.
So with our current rates, and I'm talking about customers with excellent credit,
Yeah.
conventional financing, excellent credit, not necessarily 85%, 10%. Because as you indicated before, conventional financing doesn't require 20% down in most cases. So the average rate over time is 7 to 8%. We had gone as high as 68% and back down to the high fives. In reality, relative to that 7 to 8%, you're talking about maybe 1.5% below the average rate is over time.
Right.
So from that perspective, it's a very attractive interest rate. Relative to the lowest rate of all time, it's considered high. But
Right.
that's only what's happened recently.
Right.
And when you look at financial planning should be done as looking at things over the long run. So anything less than 7 to 8%, or even 7 to 8%, is an average rate over time.
Right.
It's not a situation where that is considered a very high interest rate. The other thing to consider as well is that some people try and, just like the stock market, they try and time the stock market, they try and time the mortgage market. That's impossible to do, just like it's impossible to do with the stock market.
Yeah.
What I would tell you is that it is a little easier in the mortgage world, because if you lock in your interest rate at, let's say, 6.5%, the reality is sometime over the next 30 years, you're going to find something lower than 6.5%. That's a typical client does refinance at some point during that transaction.
Right.
And in that case, your 6.5% is really the ceiling in terms of what you're looking at an interest rate. If it does dip down below, well, then you can always refinance into a lower interest rate.
Right.
Looking at interest rate as something that ceiling helps a lot of my clients, because they start thinking, you know what, my brother Bob tells me interest rates are going to be 5% next year, so I should wait until next year. What does brother Bob know?
You're right.
Reality is,
Exactly.
if your brother Bob knew that, he'd be living on a yacht somewhere. He'd have that type of reputation. You can't know that
Yeah.
any more than you can know other things in the way the interest rates work. So from that perspective, what I advise clients is that look at it as a ceiling, meaning rates are going to be over a 30-year period no higher than 6.5%. Then you're winning relative
Right.
to the average rate over time of 7%. Even if we get into what's now considered crazy numbers, 9%.
Right.
Again, that's a ceiling.
Right.
Sometime it's widely expected that things will come down. You get back to some more normal rates, and you'll refinance if you end
Yeah.
up.
Homes are still appreciating. They're predicted, and they can predict what they want to predict, but things have been going kind of the way they're predicting. They're predicted to appreciate up to another 9% by the end of this year, and I don't see them. I don't see them depreciating in what I'm doing. They're evening out. We're not seeing these crazy high bidding wars right now. The market has changed. But pricing wise, it's evening out, but it's still appreciating. And and then it'll even out. It's predicted to even out to your typical 3 and 4% appreciation over the next few years. But they're still appreciating. So it's not as though you're buying and then they're going to, the home values are going to just diminish, especially because we're not going to see that bubble pop because of the safe lending practices we've seen over the last few years. Lenders have not been lending like they did back in 08 when we saw the big crash. There were some wild lending practices back then. They've been very careful. I know that we have had some appraisal gaps with some of my my buyers this year, and they were warned of it and understood it, but because of these high bids we had, lenders were being very careful with how they were lending. So we're not going to see that. The homes that you do buy are still going to be appreciating, and it's not like you're going to be losing value. So we learned a lot today about mortgages, and I really thank you for all of that knowledge. And I think this information will be very beneficial. And like I said earlier, if anybody has any questions, we will both come back to this and leave them in your comments below. I will have a link. Thank you, Jim, for coming. I really appreciate it. I know people will get a lot out of this, so I will be talking to you soon. Jim.Adams from Movement Mortgage. Thanks a lot.
Thanks, Wendy.
All right, bye-bye.